Welcome to the Facts versus Feelings podcast. I'm your host, Ryan Detrick, and I'm joined by my co-host, Sonu Varghese. Cutting through the noise each week with Ryan Detrick, Chief Market Strategist, and Sonu Varghese, VP Global Macro Strategist, taking out the boring and helping investors focus on what really matters. A quick note before we start the show. Investment advisory services offered through CWM LLC, an SEC registered investment advisor. Carson Partners, a division of CWM LLC, is a nationwide partnership of advisors. Hi, everyone. Welcome to a very special episode of Carson's Facts versus Feelings, episode 163. Ryan and Sonu here. Sonu, we're joined by someone I've looked up to for a long time. I know someone we've wanted to have on our podcast for a very long time. Jurrien Timmer over at Fidelity, the director of Global Macro. Jurrien, thank you so much for joining us.
Thank you for having me. It's a pleasure.
So I think I've got like 50 questions. I think Sonu's got another 50. We'll just dive in. I think it's fascinating. You were born in Aruba and you grew up in Aruba. When did you come to the United States, and kind of how did that growing up in that part of the world form kind of your view really of global macro right now?
Yeah. So I'm was born.
And how's your tan? Yeah, you're a little, where you live, right? You're in Boston, right? You're a little white looking. That's okay. I'm white. Trust me. It's all right.
My tan is non-existent. I was born and raised in Aruba, on the island of Aruba, born there in 1962, and of Dutch parents. So I'm a Dutch citizen. Well, I'm a dual citizen now of the U.S. and the EU. But my parents were there for like 35 years. And I grew up there. It was pretty wonderful. Aruba was not the overdeveloped place that it is now. It was just a quiet, sleepy little island. And it was a very diverse background, and so I think it really did help me have a worldview rather than sort of a provincial view. And so, I have two older brothers, and typically if you're Dutch and grow up in Aruba, you end up going to the university in Holland because it's cheaper, the quality is good, and that's where people's family and relatives are. Of course, I had to be different. I ended up wanting to go to the States. I met many American tourists on the beach in Aruba, and I was a little intimidated by the Dutch culture. I'm not anymore, but I just, the Dutch can be kind of weird sometimes, and the Americans were very welcoming, embracing. And so I really liked that. And so I went to college in the States instead of in Holland. I went to Babson College in 1981, graduated in 85, and I've been in the States ever since.
So do you go to Holland often? Do you ever get over to Amsterdam? Do you get to do that?
Yeah. So my middle brother lives in Amsterdam. My oldest brother still lives in Aruba. But my parents live in The Hague, and they are 91 and 98 years old. And so obviously at that age, we try to see them as often as possible. So I'm in Holland probably 3-4 times a year. And usually if I'm in Europe for business, which I am a lot, I'll kind of like do a weekend in Holland on the way back or on the way out. And so we were just all there in October for their 70th wedding anniversary.
Wow.
They even got like a medal from the mayor of The Hague because not many people make it to 70. So
amazing.
So one more from me, Sonu, then jump in. So here's my quick Holland story. So I had a roommate at Xavier University in Cincinnati. He was Dutch, played soccer and tennis. So that was Rob, great friend. Anyway, so I studied abroad in Europe, like you do 25 years ago when I was younger in college. And we went out in Amsterdam one night. Now we're in college. We went out. You can imagine all the shenanigans I got into. We woke up the next morning, a bunch of us crammed in a hostel. We looked at the door, Jurrien, and all of our shoes were lined up perfectly. We're all like, well, that's kind of weird because the condition we were in, we got home, that doesn't make any sense. We were robbed. It was an inside job. We all were robbed, and they lined all of our shoes up right by the door, and all our money. This is before cell phones and all that stuff. It was, looking back, it's kind of a funny story now. And at the time, it was pretty scary. So that's my Amsterdam story. I'm sure everyone has one. That's that. But just want to point, I don't know, just thought a funny story to break some ice. Sonu, what do you want to? Let's start with some fun here. Let's get going.
Since you mentioned Holland, I have to ask if you're a Dutch soccer fan, if you're looking forward to the World Cup next year.
I'm an occasional fan. My oldest brother is a total fanatic. Like he has encyclopedic knowledge of soccer the way I have of the markets. But it's funny. There is a soccer player called Jurrien Timber with a
Whoa.
B, Timber with an MB instead of two M's. So it sounds almost the same. And he is also from the islands. And so I get people on Twitter saying, oh, nice job at Arsenal or whatever, So it's kind of a funny story.
I must say, my favorite soccer team is actually the Dutch soccer team ever since I started watching soccer about 30 years ago. Right. So, yeah. And so apart from the World Cup, so we'll be supporting the Dutch, which I have no connection to. And I have been to Amsterdam, but absolutely no connection to. But anyway, I guess we get started. Jurrien, thank you so much for being here. I love your, I think what you do is unique because a lot of us, a lot of people out there put charts and things like that. But I feel like you use them to create a narrative and figure out what is the message of the market. Right? What is the market telling us? So let's just start there. What is the market telling us right now? What is the narrative of the market?
Yeah, so you're all right. I consider myself a storyteller, basically. And one of the things I try to do is take all the complexities and all the noise and the signal that we all are fed on a daily basis, and I try to distill it into a working narrative that, $100 billion PM sitting in the office next to me will value, but also, the average investor that's calling one of our phone reps can understand, because the work goes really very democratically to the entire spectrum of levels of sophistication and understanding. And so, right now I try to root everything in market history. So I have charts going back thousands of years, hundreds of years. And so when we are in a particular phase of the market cycle, I try to describe, where are we relative to where we would be in history. And so I look at market trends, of course. I look at cycles. I look at the market cycle, the secular trend, the role or influence from interest rates and monetary policy, fiscal policy. And so what we have right now is a bull market, clearly. That is not only cyclical, but also secular. The cyclical bull market started in late 2022 after the very, sort of violent rate reset, if you will, from the slumber of zero interest rates leading up to COVID and through COVID, and then that inflation genie getting out of the bottle, and then the Fed having to really respond to that and also respond to the fiscal impulse, which was probably not well understood at the time in terms of what kind of demand shock that would create. And so we had the rate reset in 2022. Bond yields went from 1% to 5%. That is going to do a number on equity valuations because, and one of the things I learned early in my career is that, interest rates really matter. Even if you're a stock jockey, they still matter, because if you value equities, you need to use an interest rate to discount those future cash flows into a present value, and that present value is what you should want to pay for a stock or a stream of cash flows. And so when the discount rate or the cost of capital goes from basically 0 to 5, that's going to leave a mark, and that's exactly what happened. So the S&P fell 28% in 2022. The PE fell like 33%. So it was all valuation. Earnings actually rose 8% that year. And so one of the things I do when that happens is I look at history. I'm like, okay, what can we learn from history? History doesn't repeat, but it sure does rhyme on occasion. And the first thing I noticed was, okay, well, this kind of feels like 1994 when Alan Greenspan raised rates out of the blue. And I was in the markets at the time. I've been in this business 40 years, so I've seen a few cycles. And then I start doing overlays. I'm like, okay, what's different? What's the same? And of course, there's always things that are different, but more was the same than different. And then Greenspan back in the day achieved the soft landing, and then he gave back some of the rate hikes in 1995. That's also when Netscape went public, and so the internet boom was born. You fast forward to 2022, 23, Jay Powell delivered the soft landing. Remember we were all obsessed about the yield curve at the time, and we can talk about that as well. But the soft landing came in November of 2022. ChatGPT was launched. And so you can see the parallels, even though they're different. And since then, since October 13, 2022, the S&P is up 100%. So that's a nice cyclical bull market. And obviously, fiscal policy is a big part of that. You know, the Trump administration, the Republican Party, what that does to, you know, animal spirits in the economy. Of course, the AI boom is a huge feature of this. And we are now, at least by my estimate, in year 16 of a secular bull market. So you have a cyclical bull market on top of a secular bull market. And I think that's why you're seeing the kind of momentum that we're seeing here in the markets. And even after like a not scary day, but after some down days last week, you know, the market came roaring back today. That's fairly typical of bull markets. And you know, again, with history, you kind of can read the tea leaves and say, okay, you know, this feels like something I've seen before, and what happened then, et cetera, et cetera. So that's kind of how I sum up the market cycle. And of course, the monetary side is of help. You know, the Fed is cutting rates, maybe not as much as the market would like, but you know, the 10-year Treasury yield is at 4.12, so that's very benign. When it goes up towards 5, that's a big problem for the stock market. But right now, things are fairly quiet, and the thing that we're focused on most, and that the question I'm getting asked the most, is are we in a bubble? That's what everybody is asking, and my short answer, my somewhat flippant answer is, well, if that's the question everyone's asking, the answer is no, because that's not how bubbles work, right? Bubbles are chaotic, irrational things, and you can't use your linear mind to understand them, because if the market was that linear, you would never have bubbles. So that's my short answer there.
So just so everyone knows, we are recording this on November 11th, Veterans Day. So thank you to all the veterans out there for sure. And so you're in this will come out in about 2 weeks, just as I think, just so you know. So I love I just looked to my left because this is my CMT. I know you have a CMT, Chartered Market Technician. I was the 499th CMT. And it looks like it was October 17, 2025. That's kind of crazy. So I've been a CMT for 20 years now. You know, looking at your career, you started in fixed income. I'm going to assume you weren't always kind of a charts person. What kind of pulled you or gravitated you toward using charts? I love what you said. You said you're a storyteller. Literally, when people ask me what I do, storyteller is one of the first words that I use, because I love to create charts and tell stories. I love looking at history. I love looking at sentiment. I know you do all those things also. What gravitated you to charts over the years, though?
I'm just a visual person. You know, when you roam the floors here of my building here at where our asset management is located, you know, some people consume information through like numbers and tables, and I do as well, of course. But some consume it through charts. And even before I landed at Fidelity, I've been here 30 years now, and I was working on a fixed income desk for a Dutch bank in New York. I just couldn't help. Like, I'm just a visual person. It just speaks to you one way or the other. And I started, and I'm always been a storyteller. My father is a brilliant writer, and so I kind of, that combination of charts and wanting to tell a story, I even started back then. And then Fidelity came looking for the most narrow position you could possibly imagine, a chartist in the fixed income group, right? So,
oh boy.
So there's charts, and then there's bond charts, and there's only so much you can do if that's all you do. But, you know, it was Fidelity. I was ready to make a change. So I took the job, and I quickly sort of pivoted towards multi-asset and later multi-discipline. And we can talk about that. But you know, Fidelity has a legendary chart room, and Fidelity's former leader, Ned Johnson, he personally hired me, actually. He was my last interview. And, you know, we would spend hours every week just poring over charts in the chart room. And the charts in the chart room are done so precisely, right? Semi-log scales, the lighting, the grid lines are just, just so, they're just works of art. And so he really was sort of a mentor in how to display quantitative information. So that was really an instructive period for me to take my charting to the next level.
Do they have like a no food drink policy in that room? I would assume, because I'm kind of messy. I don't think you want me in there eating. How's that working there?
I think I had a coffee when I was there a couple of years ago. I may have, but a lot of them are on the wall. I must say, like on location, being at the exchanges is really cool. Like the NYSE or this. I'm in Chicago at the SIBO.
Yeah,
there's something neat about being there, especially the SIBO, because it's still open outcry and things like that. It's still a hybrid exchange, right? But that chart room, I must say, is one of my favorite places to be on location anywhere within the world of finance. It's so cool.
I by the way, I was in the bond pits of the SIBO, not working, but when I worked for the Dutch bank, they owned, probably still do, a bank called LaSalle National Bank, which was right there. And so I would go every few months, and we would work with a broker, and so I got to kind of hang out on the pits. And it was so, it was like, trading places. It was like so cool.
Yeah. There's so much energy there.
Yeah.
Yes. So, I love what you said about the bull market and how you sort of differentiated between the cyclical bull market and the secular bull market, which you said like 16 years ago or thereabouts, right? I imagine bull markets don't die just of old age, but what brings bull markets to an end?
So secular bull markets come to an end. Well, we've only had a few, right? So we had the 20s. That ended up in a bubble, and bubbles tend to just implode on themselves. So that was one. The 50s and 60s was another one. And that one was essentially ended by inflation, right? So in the second half of the 60s, we had very loose fiscal policy, like year after year chronic deficits, kind of sounds familiar. And there are many similarities with the late 60s and really the post-COVID period. And monetary policy was way too loose as well. So back then, and I actually studied the Fed going back like to the 40s to the 60s, really fascinating to read kind of the blow by blow of what was happening and the political meddling and all that stuff. But monetary policy was too loose because, policymakers were still traumatized by the Great Depression, the war, deflation. So the policymakers didn't even really think about interest rates in real terms. Seems like ridiculous right now. And so they were kind of asleep at the wheel, if you will. And that combination of fiscal and monetary loose policy eventually created, the great inflation. And of course, we had the Vietnam War, we had guns and butter, and there's some similarities there with COVID. I mean, COVID wasn't a war, but it was like a war on COVID, so there was a lot of deficit spending. But anyway, so that, and then in 1968, which was the final peak of that secular bull, we had a bit of a speculative bubble with retail investors or traders, kind of the day traders of the time, because we had the glamour stocks and like the space stocks and the electronic stock, any company with the word tronics in its name would just trade to a 50 multiple, whether it did anything or not. And so that bubble burst. It was not a big one, but it was a bubble. And then fast forward to the late 90s, of course, and that was a bubble from the 1998 low after long-term capital to the 2000 peak. The big growers in the S&P, like the top 50 names, for instance, they went from a PE of 20 to a PE of 40, while the rest of the market stayed at 20. So that was clearly a bubble, and that bubble imploded on itself. So right now we're in year 16. They tend to last 18, but you don't want to, it's not an exact science, right? It's a sample size of 3. So we don't want to read too much into that. But right now, you have loose fiscal policy. Monetary policy is neutral. You obviously have a very compelling, juicy story around AI. Will that boom become a bubble? Will there be the overinvestment that we saw in 1999? We don't know the answers yet, but that's typically, it's always about valuation. And it's either valuations being eroded by inflation or valuations becoming excessive, and then it just implodes in on itself. But that's typically how secular bull markets end. The cyclical ones, of course, follow the business cycle more. So you have, an overheating economy, you get inflation, then the Fed has to tighten, and then you get the inventory corrections, and a tightening Fed means an inverted curve, and then the banks stop lending. So that's much more of a business cycle phenomenon.
It's interesting that even I've been thinking about, like, there's so many parallels being drawn to the late 90s period for obvious reasons. Yep. But I've been looking at that 67, 68 period for, loose fiscal policy and then monetary policy too. And I don't want to say Fed independence. I mean, that is a very nebulous phrase, but it just seems like there are so many parallels, interestingly, across both those secular bull markets that we've had, as you see, both the 60s and then the 90s too.
And it's worth pointing out that, the meddling that we see with the Fed by the White House today is nothing new, right? This is as this happens with every Fed, but sometimes it's a little quieter. Not every president has a social media platform, but in the 60s, whether it was Republican or Democrat, both Nixon and Kennedy, they were meddling and trying to influence monetary policy. And when you have a lot of debt to finance, you're going to try to push rates down. And the 1940s, which I thought was a very good parallel to the COVID lockdowns or that period, I think really spoke volumes as well, because the Fed was not yet independent back then. It happened in 1951, and the Fed's job literally was to make the wartime debt as fundable as possible. So the Fed capped long yields at 2.5%, capped T-bills at 3/8, and essentially incentivized the banks to play the yield curve. The banks sold their T-bills to the Fed and bought long bonds, and the social contract was the Fed said, we're going to honor par on those 2.5% long bonds. And the banks just did that for years, and that's how the war was funded, basically. And of course, even though par was honored in nominal terms, of course, inflation was 6% while the yield was 2.5%. So that did a number on real returns, but that's another story. Yes, they would.
Yes, they would. Yeah, so you joined Barry Ritholtz on the Masters in Business podcast last month. I listened to that, getting ready for this. And one thing I wanted to dive a little bit into, so Sonu and I manage our team at the Carson investment research team. We manage almost $7 billion for our financial advisors and their clients. And one of the concepts you brought up was the idea of barbell. Right, you talked with Barry. I'd love you to dive a little more, but like Mag 7 on one side and kind of the cheaper, underloved, maybe potentially EAFE on the other side. We have some barbelled approaches as well. I don't know if you want to talk about portfolios, but just tell me about that barbelled approach, how you see people should potentially be investing here.
Yes, it's a great question. And so one of the big things that I think about, and my team here, so I work in the asset allocation group at Fidelity, is, how do you manage tail risks, right? So generally, if you have a bell curve distribution of outcomes, by definition, generally you're somewhere between those two standard deviations. Otherwise, it wouldn't be a bell curve. But occasionally you go to the tails, either a left tail or a right tail. And certainly over the last, year since the election, we've been kind of lurching from one tail to the other, right? At first, it was a bullish right tail of deregulation, tax cuts, animal spirits. And then we had the left tail of the tariff tantrum earlier this year. And now we're back on the right tail in terms of the one big beautiful bill, the AI story. So how do you manage the tails? And one of the potential tails, so there's several, of course. One of them is that the very benign interest rate environment becomes less benign, right? So let's say the administration manages to flip the Fed, which very clearly is what it's trying to do, and the Fed were to drop rates to the 2% you just mentioned, that would be below the inflation rate. The long end of the yield curve wouldn't like that, right? So you'd get a bear steepener. When stocks and bonds are valued similarly, right? So the PE on the 10-year yield. So if you invert the yield of 4%, the PE is like 25. The PE on the S&P is 25, right? So if the risk-free asset becomes cheaper because the curve would bear steepen, the stock market has to respond through a lower PE in order to compete against the risk-free asset. So that is one till. And in an era of what we call fiscal dominance, where fiscal policy is really going to dominate, that is a significant till risk that we need to manage. And that gets you into kind of in a 60-40 type of paradigm. That gets you into a question of what do you do with the 40? Should the 40 be 40? Should it be 20? If it's 20, what do you put in the other bucket? Is it gold or Bitcoin or alternatives? So that's one part of the till. But the other one, which is what you're referring to, is, obviously we have a booming stock market, not only this cycle, but secularly as well. And the U.S. market has dominated the global landscape now. Not this year. The foreign markets are actually outperforming, but for the last 10, 15 years, it's been all U.S. all the time, the U.S. exceptionalism, all that stuff. And that has created a very, good story in terms of returns, but it also has created a lot of concentration risk, right? So top 10 stocks in the S&P is over 40% of the index. Mag 7 alone is like 36, I think. And when those stocks go up, it's great, right? Because it elevates the cap-weighted S&P beyond what we would otherwise experience. And we see this, right? The S&P equal weighted, I think, is up like 7% for year to date, and the cap weight is up 17%. And so if you're a passive investor or you use the S&P as a general building block, that's going to make you very happy. But concentration risk can cut the other way as well. So if the AI boom ever gets overhyped and the players in that space, the big growers, go to PE levels that make no sense, right? And just to give you an example, back in the 1990s, the poster child of that internet boom turned bubble was Cisco Systems, right? They were providing the routers. And in 1998, when that bubble started, its PE was like 50. And in 2000, its PE was 215. All right. That's
when I bought it. I was in college. I had no idea what I was. I think I bought it on like March 9th of 2000. Everybody just look at what Cisco did after that. Yeah. Live and learn.
That gets you to the silly season. So if we take NVIDIA, and I'm not a stock person, but, it's trading at a 50 PE, trailing PE, 35 forward. So it's nowhere near those levels. But you could imagine at some point that concentration risk will cut the other way, either because it's a bubble or just that story has ended and the AI boom turns to the downstream or the killer app side or whatever. At that point, if those stocks ever go down, the index is going to go down. So how do you hedge against an environment where your primary source of market beta is no longer there? You have to go to alpha or to get beta somewhere else, which I guess is saying the same thing. And so the first inclination would be, okay, I go down cap in the US, you buy Russell 2, or you somehow figure out a way to get an equal weighted exposure instead of a cap weighted exposure. But what I'm seeing now is that there's an easier way, I think, and that is that non-US equities are now very competitive, which is something they hadn't been until this year, right? So we've always had conversations here about, okay, whether it's emerging markets or developed markets, it's the MSCI EAFE index, they trade at a fraction of the PE of the US, so why don't we just put some money there? And I said, well, yeah, great, but until you have a catalyst in the form of the fundamentals, the valuation is not going to get you anywhere, right? You can have a value trap. And so what's happening, especially in the developed world, so Europe and Japan, their earnings story is not as compelling as the US. They're not competing on that level. But companies there have become much smarter, much more savvy in unlocking shareholder value. And so what they're doing is that they are returning more of their earnings to shareholders via dividends and buybacks than they have ever done. And in the process, the payout ratio for the EAFE index, so dividends and buybacks as a share of earnings, is now the same as in the US. It's 75%. And the growth rate of that payout over the last 5 years is now actually better in EAFE than in the US, even on a cap-weighted basis. And the PE is 15 versus 23. So you have equal fundamentals for much better valuation, and implicit in that, your returns would be boosted if the dollar were to go down, which is a view that I hold. And so for me, a barbell of S&P cap weighted and EAFE is a really good way to start kind of the conversation.
It's very interesting. Diversification in terms of to diversify risk, right? Yeah. But also to capture alpha, to boost returns. So it's interesting, like there's both two angles there, as opposed to usually diversification is just, it's a risk management exercise. But now it's like, I can actually hopefully boost returns potentially.
Yeah, and it's worth remembering that, and one of the reasons I look at long periods of market history and these secular waves is that, if the market normally goes up 10, 11% and it goes up 60, 70% of the time, it goes down 30 to 40% of the time, and nobody likes that, of course. And then that's when we have to hold hands with our customers so that they don't sell, because if they sell, they're going to lose the compounding magic that the markets deliver. But there are periods where we kind of over harvest beta, right? Like the betas are so plentiful, for the last 15 years, it's been 15% instead of 10%. You have to keep that in mind, because that does not last forever. There are going to be times when there's going to be just less beta to be had. So over harvest now, and you don't have to worry as much about the alpha because the betas are so rich. But there are going to be times when there's going to be less beta, and where the alpha really adds a significant amount of return to a portfolio. So that's another way I think about these long cycles.
Interesting. I have a question. You mentioned going down cap in the US, and I think what we are kind of doing is diversifying our portfolios. We probably have a larger weight to MSCI, EAFE, developed markets, and I think most of the RIA is doing something similar to what we do. And that's a new position, especially at the beginning of the year. That's what we did. But going down cap, I'm curious, small caps have outperformed mid caps. And you mentioned equal weight too. Equal weight seems to be, it's still positive return. So it's not like it's negative, but it's underperforming the S&P 500 but it's also underperforming small caps. I'm curious why equal weight / mid caps are underperforming here.
So I think the small cap story is actually part of the AI story, because you have small caps. You look at the Russell 2000 or what have you. There are your typical small cap kind of domestically focused companies, and you hope that someday the AI revolution creates so much productivity and efficiency that it goes downstream into the rest of the economy, not just us as persons, but businesses, right? Just using smarter tools to gain productivity. And that's a very big part of the hope that the US and maybe other countries can actually outgrow this gigantic debt burden that we're in, because that should raise the non-inflationary speed limit for the economy. But another part of the small cap story are kind of like the non-profitable tech companies and other plays that make promises on AI, but they don't really have anything to show for it yet, which is not a slam against those companies. But so there's a part of that universe that really has gotten bid up. Like you talk about the meme stocks, you talk about the non-profitable tech. And so I think part of the story with small caps is that. And if you take that away, they probably don't look that different from the mid-cap section. But really it comes down to margins, I think. So you look at margins for large caps, whether it's the S&P or the MSCI US, margins are like 15, 16% and rising. And those, of course, those are the big growers. For mid and small, margins are sort of doing nothing, and they're much smaller. They're like 5, 6, 7%. And so ultimately, companies with high and growing margins get rewarded, as well they should. And they happen to be the really big companies with lots of scale and big moats, right? And they're hard to penetrate. And so that to me is kind of the issue with going down cap. It's not an issue, but it's kind of binary, right? So if you take money out of the large caps, putting into the small caps, you're really betting against large caps at that point. And I guess the same thing applies that if you sell U.S. and buy international, but at least you have similar fundamentals, better valuations. There's a currency aspect of that. And so I think it's a little bit lower hanging fruit to go in that direction.
That makes sense.
Oh, good stuff there. So, Jurrien, I'm going to change gears for a second. We're foodies on this podcast. I know you are as well. So you get to travel the country. What are some of your favorite cities to visit when you hear, I get to go there? Like, you're excited because the food's good, or is there a restaurant that you can recommend that maybe is not so popular, but as you travel and you've tried a lot, what excites you when you get to get on the road there?
I
know, how much time do we have, right?
Speaking to my heart now. So ever since COVID, I have been hanging my hat occasionally in Santa Barbara, California. It was one of those things during COVID. We're all locked down. People are going to Florida. I'm like, I don't want to go to Florida. I'm going to go to Santa Barbara for no other reason than I'm a cyclist, and Lance Armstrong used to train there for the Tour de France. So that the name was sort of implanted in my head. And the food scene there, I mean, not that San Francisco or other cities, places in California aren't, but I just fell in love with the food scene because everything that is on your plate is from like within a 50-mile radius. It's all organic. It's fresh. The avocados are perfect. In the East Coast, whatever you buy in the winter, it's traveled like 1,000 miles to get here, right? And so, and so, even like a bad restaurant has good food because the ingredients are so fresh. And I'll go to the farmer's market there, which is twice a week, and you see restaurateurs with big carts, and they're buying these incredible like little gems that you could like. They don't even look real; they look so perfect. And then there's a fish market there where everything is on the highest sustainability grade, right? It's shipped in from everywhere, including local. And so that to me is my food haven, if you will. But in Europe, there's great food. There's a great like omakase place in Seattle. So whenever I get to go to Seattle, I'm like, okay, I'm going there. So there's so many good places. But what happens is I cook a lot. So people always ask me, what are your favorite places in Boston? And it's like, well, I don't have any because I travel so much that when I'm not traveling, I'm cooking at home.
I think I heard another podcast where you mentioned like you're a bit of a chef yourself. I was curious, what do you enjoy cooking?
My current favorite dish, which actually I'm making tomorrow for about 10 colleagues of mine here in the asset allocation group. I have a tradition where a couple times.
Hold on, you might want to make it 12. You might want to make it 12 after what you're about to tell us. Make 2 more plates. We might show up.
So I have this tradition where in the spring and in the fall, I invite some of my colleagues over, and we do like a plated dinner, and we chat, and it's great. So my current go-to dish for in terms of scaling, because I tend to have at least 10 people at the table. That's what my table fits. Is and a lot of these things I learned from TikTok videos. TikTok has great food videos. So like a puree of sweet potatoes. So you cut them up, cook them with the lid on, with some butter and water and salt, and maybe some Thai chili and maybe some coconut milk, and then you puree it in the Ninja blender, and that creates a very beautiful creamy base for a plate. And then I do like the simplest hack. I take leafy kale. I mean, like the most peasant of all the vegetables. I cut them into strips, toss them with olive oil, salt, and pepper, or even everything bagel seasoning goes really well. And I'll bake it at a high heat, like 450 degrees for 10 minutes, and it turns into these crispy, salty kale chips. And then I do a play on the Nobu black cod dish, but I'll use Chilean sea bass, and I'll marinate it in sake, brown sugar, soy, mirin, and I'm missing one. There's one other. And miso. Sorry, miso. How can I forget the miso? And I marinate that for 24 hours, put that in the broiler. So the key thing about cooking for large groups is you don't want to be scrambling at the last minute, right? When the guests arrive, my kitchen is completely clean. And so the fish is in the oven, the kale is resting in the oven, and the sweet potatoes are in a pot just simmering. And then you plate, put in some microgreens, and then a little sprinkle of like a balsamic glaze, And that's my go-to dish right now.
I'm starving now. I heard that. I'm like, I need to go out for lunch. And I'm actually going out for lunch, but I may pick a seafood dish now. Now that you mentioned it, that sounds amazing. That made my day.
Right. I don't even know where to go now, because now I'm thinking about food too. A couple more things. We'll get markets related. People like to talk about Bitcoin and gold. I saw, Jurrien, where you said they are different players on the same team. What are your kind of thoughts on Bitcoin and gold here?
So my macro thought, and I went down the Bitcoin rabbit hole about almost 6 years ago, actually, is that, and again, there's a lot of crypto natives out there on social media, and they have very strong opinions, and not incorrect necessarily, but they are coming from that world and not from like our 60-40 TradFi world. And so I brought what I think was a unique perspective, say, okay, I'm looking at Bitcoin from a 60-40 type person. Like, does this fit anywhere? And if so, where? And what asset, what bucket would it go in, and what bucket would it take funding from, right? And my conclusion was that because of its scarcity factor and its decentralization, that it looks like digital gold, which is now it's now a very common narrative to call it that, or exponential gold. But that's how I approached it. And at the time, of course, this was during COVID, we were in a financial repression mode, right, where the Fed was dropping rates below inflation, doing QE, there was fiscal stimulus going on. And so that made bonds sort of an impaired asset class. I mean, we saw how impaired it was in 2022, and the correlation went from negative against stocks to positive. And when they go positive, they stop being a good diversifier. It doesn't mean you shouldn't own bonds. I mean, the spread over inflation is positive. So they're a viable asset class, but you want something that's going to protect you not only when the 60 goes bad, but also when the 40 goes bad. And that asset class is gold, actually, because it is neither correlated to stocks or to bonds. And if you go back, 100 years, the times when the bond market did the worst, gold did the best. So it is a hedge against rising rates or financial repression where real rates go negative. And then Bitcoin becomes a player on that team. And it's interesting when you look at correlations across all asset classes, gold and Bitcoin are negatively correlated against each other, which is fascinating. And it's counterintuitive, because if they are on the same team, they should be positively correlated. But it's like they take turns. So they're different players on the same team playing at different times. And we see this, right? If you look at the Sharpe ratios for gold and Bitcoin, they go in opposite directions. So there'll be a time when, like recently, where gold was running and Bitcoin was just sitting there doing nothing. And then you have times, for instance, in 2020, when Bitcoin was running and gold just sat there, did nothing. So to me, that's like a little bucket in a portfolio. And this is just my own opinion. This is not investment advice. But if a 60-40 is now like a 60-20-20 or a 60-30-10, I still want the 60 to be equities, but I want it to be more global to deal with concentration risk in the Mag 7. And then on the 40 side, I don't want to have all 40 in bonds, because I do think in an era of fiscal dominance, there is a chance that we'll have financial repression again, and then bonds become less appealing. So maybe it's 20, maybe it's 30, whatever. And then that final bucket is, for me, again, not investment advice, but it's gold and Bitcoin, and then other sort of cats and dogs, like alternatives, like long, short, managed futures, absolute return, tips, things like that. And to me, that's how I think about a diversified portfolio these days.
That's fantastic. Yeah. I love how you connected all of that into like portfolio asset allocation, right? Which is what I like we do. I have one question. I mean, you mentioned financial repression, so just bring the Fed into it. So when they started cutting last year, in September of 2024, core inflation, these measured by personal consumption expenditures index, about 2.8%. Fed funds rate was at 5.5%, right? Somewhere around there. And you say, okay, this is definitely tight, right? There's room to cut. Now, core inflation, core PC is about 2.9%. It seems stuck, right? Core CPI is at 3%. The Fed funds rate is at 4%. Do you think, and you mentioned, a little while earlier that rates seem to be at neutral. I'm curious if you think the Fed should even be cutting right now. And then, irrespective of our views, all of that, where do you think rates go from here in terms? I know markets are expecting 3% rates, but markets could be wrong, right? They were wrong in the beginning of last year. They were pricing in 7 cuts. We didn't get that. I'm curious your thoughts on all that.
Yeah, it's a great question. So yeah, during COVID, inflation went from 1.5 to 9 using the CPI, or about 6 using the core PCE. It's back to 3, but it's been kind of 2.5, 3 for over a year. So it's really been stuck, right? And that's a problem, because if you look at longer term averages of inflation, if the target is 2 and you go from 2 to 9, you need to go back below 2 to stay at 2 as a longer term average. And we haven't done that, right? And it looks like the late 60s, and not to sound too alarmist, but the same thing happened there during the Vietnam War. Inflation went from like 2 to 6 back to 2, and then it went back up, and that brought the longer averages up. So we're kind of stuck at 3. 3 is the new 2. And that 3 is not a problem for the stock market. If you look at valuations versus equity returns, 2 or 3 doesn't make any difference. Like it's still the sweet spot, right? 10% makes a difference, but not 2 or 3. And so what the Fed has been doing is it was quite restrictive at 5 3/8, and that was 200-300 basis points above inflation, which is typically where a Fed tightening cycle ends. And then it started tweaking. So it did 100 basis points last year, as you said. Long end of the curve did not like that, right? So the long end steepened by 100 basis points. And now that's quieted down. Long end is at 4.1. Obviously, the jobs market has been soft, not contracting, but soft. But inflation has been sticky. So I think the Fed is just calibrating, going from severely restrictive to moderately restrictive, where it was last year, to now kind of being closer to neutral, but maybe not quite a neutral. So it has, Fed has a dual mandate, right? Full employment, price stability. And the price stability would prevent them to go from neutral. But the employment side, which clearly has been soft-ish, is what I think is driving the needle towards going to neutral. So I think the two are offsetting each other, and that's why the Fed wants to do a slow grind back to neutral as long as the data support it. And it was waiting for that data to support it, 6 months ago. And the inflation numbers haven't changed, but the jobs numbers have. And I think that's what has caused Chair Powell to say, okay, let's do a couple more here. So they're at 3 7/8. Inflation is at 3. So they are, and my sense is a neutral rate is inflation plus 100 basis points, like our star. And even the Fed's own summary of economic projections states that their sense of long run neutral is 3%. So 2% inflation, which is their target. And they're never going to say, well, you know what, maybe 3 is the new 2. They can't.
Right. They won't say that.
So 2% plus 1 plus 100 basis point is 3. And so that's why I think the SOFR curve is at 3.1 as the terminal point. So I think that's the goal, to get there. But they will get there slowly or quickly, depending on how those two mandates are working. And in the meantime, of course, we have this ideological divide now between kind of the Fed people that are on the Trump side, in terms of like Stephen Moran saying, well, neutral is more like 2% because of immigration and this and that. And it's kind of a clever argument to make, because it all comes down to what R star is, and R star cannot be measured in real time. So no one can tell them that they're wrong, because they cannot do the counterfactual. So it's all theory. But that's going to be a debate we're going to have for a number of years. Like, what is neutral? Obviously, the White House administration, the Treasury Department wants lower rates because they have a lot of debt to finance. And then it's a question of how many people on the Fed are kind of the status quo types that look at the dual mandate and this and that, and how many are trying to talk the book, if you will, of the Treasury. And that's going to be a live conversation because, as we all know, Jay Powell is retiring as chairman in May. So that's definitely something that's going to keep popping up from time to time.
I'm just amazed that they've reduced rates by 150 basis points, but the 30-year mortgage rate has it's stay around 6.5%.
Yeah.
Right. And I think that speaks to the struggle, like probably for the administration, like, no, we need rates much lower to push that down.
Yeah.
Well, we could go all day. We probably need to wrap this up. Jurrien Timmer, thank you so much for joining us. Thanks to Ian for putting this together. One final question, kind of wrap it up, and you can take this how you want. You've been at Fidelity for 30 years. We work with financial advisors, Carson Group, Fidelity. A lot of synergies here. What are some things you've learned over those 30 years that kind of help you want to stay there for 30 years, but also just little tricks of the trade that you've learned to really build relationships with people?
Yeah, so I have been here 30 years, and it's obviously a great company. We're all playing for the same team here, not to bring the Bitcoin narrative back, but we all have the same mission of, obviously benefiting our customers to help them save for retirement or what have you. But the company lets us do it in a way that kind of plays to our strengths, right? So I'm kind of doing something that's fairly unique. I publish on the weekend. I travel during the week to go and spread the gospel, if you will. It's a very counterlinear work week, if you will, but it's all cool because we're all working for the same mission. And I think that's one of the great things about this company, and it's very innovative. And in terms of the markets and the message, having this is one of the few professions other than maybe medical or legal where, there really is no statute of limitations in terms of, okay, you've done this for so many years. It's time to pull the hook, as long as, so it gives me the benefit of a lot of experience when I look at market cycles saying, okay, I've been doing this for 40 years. I've been through 12 bear markets. And one of the things I've learned is that they all look really, really scary when they happen and you think the world's going to end. But usually within a few years, you're back at highs and, never short the U.S. or even the global, but especially the U.S. dynamic economic story. And so just having that, I guess, comfort, if you will, that even if it takes a long time, it does eventually happen, or it has eventually happened in the past. And just the benefit of having real-time experience, like, in 2022, thinking back to, boy, I remember Greenspan in 94 like it was yesterday. And, like you can read that in a book, you can ask ChatGPT, but having actually lived through that adds a dimension to it.
Well, that was great. This whole conversation was awesome. Jurrien, thank you so much for joining the latest Carson's Facts versus Feelings. We greatly appreciate it. With all of that, everyone, I don't know how we're going to top it next week, Sonu. It's just you and I next week. We're not going to be able to top this. We'll be back next week with a regular podcast. But Jurrien, one more time, thank you so much, and appreciate all the listeners out there. We'll be back next week. Thank you. Take care. Information provided on Facts versus Feelings with Sonu Varghese and Ryan Detrick are for general information only and are not intended to provide specific advice or recommendations for any individual. The statements and opinions of show guests may not be reflective of CWM LLC or its affiliates. Past performance is no guarantee of future results. All indices are unmanaged and may not be invested in directly. Investing involves risk, including possible loss of principal. No strategy assures success or protects against loss. To determine what may be appropriate for you, consult with your attorney, accountant, financial or tax advisor prior to investing. Guests on Facts versus Feelings are not affiliated with CWM LLC.